Hi all, Joshua Stega here from etfadvisor.com.au. Time for our usual weekly update. We'll take a look at the ETF market in Australia and what we'll be looking at for the week ahead for investors. So 3 items I'm going to touch on today. Number one, we're going to look at the Aussie dollar and the implications for ETF investors in Australia, particularly with, international exposures that are unhedged. So we'll take a closer look there. Number two, we'll touch on how the index kind of comes unstuck in a market environment that is starting to rotate like it is now. So I'll just touch on that as well and just show you why you have to be a little bit careful at the moment. And number three, I'm going to take a closer look at those resources. Obviously, that's the main game in town and what my view is now just in terms of a broad spectrum of these resources and how they're all moving. So let's get started first with the Aussie dollar. And you can see it's had a really big week. So it's up about 3.5% there just in the last 7 days. So you can see pretty much coming out of that downtrend now. So we're starting to pop up here. And that was our next kind of target around that 70 cent. Well, initially it was going to be around 68 and now it's 70 cents to the US dollar. So we'll see how that plays out. But you would have to say the bottom is in for the Aussie dollar. So that has implications for investors. It might play out something like this, but that has implications for investors in Australia, particularly obviously our focus ETFs as well, is that if you've got if you're investing in international shares, say you're investing in the Nasdaq or the US market, and you've got an unhedged exposure, this has obviously been a huge benefit to having a weakening Aussie dollar because you've had, say you invested here when the Aussie dollar is above, say closer to 80 cents. So you're buying US assets with a pretty strong dollar, which then weakens significantly. So you've picked up, just in terms of the currency, so not only have you picked up some value in terms of the US markets moving over time, but say from back here, you've picked up from the currency, I'll just measure that. So it's not coming up. So from the currency, I'm just doing it in reverse. So you picked up about 30% there just in the currency. Just the fact that the Aussie dollar has weakened versus the US dollar. So that's been a big tailwind for Aussie investors over the last couple of years. And now that looks like it's really starting to change. So you can see now the environment's changed. It's about resources. It's about, obviously the other factor, and that's something I want to touch on, is the position of the economy as well. So in terms of Australia, obviously we've got a lot of resources as well. But now we're starting to see, so this is the futures implying forward interest rate rises. So we're looking at an interest rate rise as soon as next month. And then, from where we are now, 3.6 to probably, it's going to be 4.1 around, just based on these estimates, around the end of the year. So that's a pretty significant jump. And that's one factor that plays out in terms of the attractiveness or the value of the Aussie dollar. And the other factor as well is that, we've got to compare where we sit in the world. So you're looking at the central bank policy rates, and you can see Australia's here, and our obviously last move was a cut. But this could, as early as next month, could well be a rise. And you can see a hike. Not many people are already hiking. So you've got Japan, obviously they've got their own issues. You've got Taiwan, and you've got Brazil that are hiking. Everyone else is still in that cutting phase in green. So pretty significant in terms of we're starting to look like a bit of an outlier. Plus, obviously, the government, I think, are making some real mistakes and spending way too much. Inflation is going to remain high. So you've got like a kind of quite a few things playing out. You've got resources finally strong again. You've got a government that continues to spend money. Inflation is extremely high. Interest rates need to go up. And that sits in opposite to the rest of the world, which obviously then doesn't have those resources, doesn't have a position in their economy where they need to start raising rates. So it's going to be really, could be quite significant here. And obviously the Aussie dollar had been really low for quite some time. So just in terms of a simple trend, it's popped out of that and it's just going to shake around here. But it's not out of the question. 70 cents, 75 cents, 80 cents in the near future, if not this year. So that in itself will be a significant headwind for Aussie investors. So you could lose just 20%, say, on the currency alone, just in terms of it creeping it back up from where it is, and certainly from the start of the year, or from those tariff lows, it got back to 80. There's 33%. So you could buy the Nasdaq today. The Nasdaq could remain flat. If you've got an unhedged exposure, you're going to lose 30% of your value. So this is something that we haven't seen for quite some time. We certainly haven't seen. I mean, even look going back in terms of the strength, this has been a mass. So basically, since 2012, when it was over parity, this has been a basically, what's that, 15, 13 years or 10, yeah, 15-year cycle now of just down, and that's looking like it's going to turn. So you've got to keep that in mind as an ETF investor. So it's going to have huge implications. Obviously, the purest way to play things at the moment is a hedged exposure. And if we've got the view that the Aussie dollar is going to continue to appreciate, you could just, if you get an unhedged exposure, say you just buy NDQ or something like that, even, you basically just assume that the Nasdaq's going to remain flat, you're still going to lose potentially, if the Aussie dollar continues to appreciate, 10, 20, 30% on the currency alone. So you've got to be so careful there. And that's something we're going to be watching very carefully for our investors. And that also includes now these, the core ETFs as well. So these are going to be unhedged as well. So they've benefited massively from a weakening Aussie dollar. And if that's going to change, these core ETFs might be really slow, which then drives home even more the requirement to use your satellite portfolio, to use some hedging investments or themes and sectors that you can get hedging on to protect you from that move. So that's a big shift, and I can't see it changing anytime soon. It's a different cycle. It's a resources cycle. We haven't seen this since, pre-GFC and slightly after the GFC. So even looking at the Aussie dollar since 2012. So huge change. Be really careful. So number two, linked to that, we're going to look at the indexes. And this is one amazing thing that I saw when I was doing my weekly update to subscribers. Just have a look at how things have changed. So this is the Aussie market sectors. So these are all the ETFs covering different sectors in the Aussie market. And what is quite telling is that basically, there's only one sector that has actually performed over the last 3 months, and it's actually smashed it out of the park. So it's done, and what sector is that? Well, it's resources. They've done over 16%, 16.5% in 3 months, and then look at the rest of the Aussie market. Obviously, look at tech. It's gone the exact opposite way. So there's like a 20%, almost 20% or 40% differential in terms of you stuck into tech and said, oh, that's the previous winner. That's what I've been saying to investors. You've got to be prepared to rotate. And that's exactly what's happened here. If you sat in there, you've lost 20% instead of switching to there where you could have gained 16. And that's 35% just gone right there without making a rebalancing choice. So that's a big step change. And now, so that has implications as well. So we know that this environment, we haven't had resources at the strength they've been for years and years and years. I mean, look at that 1 year return. And that, but if you drew that back further, let's see if I've got it here. So you're looking at your five-year return, and you can see that still banks were the leaders. So they're up 100%, but just in terms of the resources are making a strong move now, and obviously playing catch up. But it just shows you they were the leaders, the financials, the tech stocks. We don't have that much data for tech because it hasn't been around that long. But now these things are starting to underperform. You can see here over your month, over your 3 months, and these things are starting to outperform and playing catch up. So there's still, another 20% or 10 to 20% there that needs to be just to play catch up just on the 5-year performance. So big things underway, and that has implications now. So if you're going to have a look at your Vanguard Australian Shares ETF, you can see high yield ETF, which has obviously done very well over time. The problem with these is and why they've done so well, the banks have done well, the banks pay dividends, and these still remain big holdings, and there's really not many alternatives. Obviously, BHP now is their biggest holding, but there's not really many alternatives to generate an income in Australia, and that's the thing. So if you then look at the chart, you can see these are starting to stall out here, and that comes down to because the financials are stalling out. They can't really move high here. But as an example of where that money's flowing, you look at something like beta shares, small companies, and that's in trend. That's just come out of absolutely nowhere and just shooting away consolidation and just kept going, and it's just in trend, uptrend. So you can see that big switch going on. But everyone, because of the way the indexes work, the indexes will buy. I mean, look at STW. The indexes will buy the most of the stock that's basically most overvalued. So this is where they really become inefficient in a period of rotation. So that's, you look at STW, you can see their biggest holdings are still going to be the banks, and the banks are starting to underperform. And then it's not until you get down here, we've got some BHP there, you've got Rio, but in terms of a percent of the portfolio, it's not as significant. So let's just have a look. It's financials still at 30%. Obviously, that's even come down the last few months just in terms of underperformance. And materials are 25%. This is a top performing sector, and none of these are doing anything at the moment. Energy is not doing anything yet, and all these are struggling. So that's the thing. You're relying on 1/4 of the index to try and hold up or push that ETF. And that's why, you've got to have that satellite portfolio. You've got to say, hey, resources, it's pretty obvious they're in trend. I want to get exposure to that, or small caps, because there's a lot of resource companies in the small caps. I've got to get some access to that. I can't just remain in the STW, in the standard ASX 200 index. And that's the thing. That's why this isn't going. It's struggling. And if you look at your OZF, which is a financials index, it actually looks like a really solid textbook head and shoulders pattern. And look, it could break down at any time. It could do an ATEC. There's your head, there's your shoulder, there's your other shoulder. It's right at the bottom of that neckline. It's chopping around there. If this breaks, this neckline, boom, look out below. And where did we see that prior? ATEC. That already happened in ATEC. It's not out of the realms of possibility. So this was a bit, and this is very fast actually. I'll try and get a good view there for you. But there's your head and shoulders here as well. So there's a little head, there's your shoulder, there's your shoulder. Once that neckline broke, boom, straight down. It's back to kind of what was that? Yeah, tariff levels. So, I mean, this kind of looks like it's bottoming out, but that's a solid downtrend. And as I said, that this has cost you 35 to 40% by sitting in ATEC and not rotating to resources when the time was right. When that head and shoulders pattern broke down and resources started to uptrend, why would I want to sit in here when I can be in something that's moving up? And even quite simply, I could have just bought the small caps ETF as well. So it's around the same time that that ATEC failed, about here, is when the money started rotating into the small caps, and that's exactly what you've seen. So that's the thing, you've got to keep this in mind, and this is where the indexes, when you've got a rotational environment, the indexes are going to get trapped, and you can just see that amongst all the charts. STW stuck, VDGR, so that, as I said, the core ETFs are stuck. Even your VHY, your income ETFs, they're all kind of stuck. And that's the thing, you've got to realize, wow, how I'm going to counteract this. Obviously, one way to do that is with satellite. And as I said, rotational environment is very damaging for the previous status quo. For the last 10 years, it's not always going to be the same. There comes a point where things rotate, and that's happening now. So you're going to get caught if you're relying on thinking what happened in the last 10 years is going to continue for the next 10 years. It's definitely not. And you can see those charts. They're just not doing anything. And exactly the same thing is happening in the Nasdaq. And let's just have a look there. So you're looking at the Nasdaq. This was by far the leading index. Obviously, it's done so well since the GFC, just up and up and up. And that's the only one you ever wanted to watch. Well, guess what? It's exactly stuck as well. But then let's have a look at the components of the Nasdaq. And you can see, because the tech stocks have run so hard, they become such a big part of the market. So you're looking at just a few large stocks. These are all tech stocks, and it's not until you get Walmart or Amazon, yeah, I suppose is part part tech stock, part consumer stock. But pretty much everything there is tech related. If tech starts to underperform, there's 52% of that ETF, of the Nasdaq index, is tech related. If tech starts to underperform, that ETF is just going to do nothing. It's going to be stuck. That's the best case scenario. Worst case scenario, it can start to collapse. And that's the thing, that as you can see, the Nasdaq there versus Nasdaq Unhedged in Australia. So this is an Aussie investor. We're starting to lose money, even though that Nasdaq is flat. This is the currency playing out here. That's a currency move, because if you have a look at the Nasdaq, it didn't move like that this week. It was actually pretty flat. So this is the thing. There's so many things happening here. Rotation, a changing of the guard. And if you're not prepared, you don't know what you're doing, you're going to do some serious damage. And as I said, those currency moves alone can cost you 10, 20, 30%, 40%. And then you've got, if you're in the wrong sector, if you're stuck in ATech, if you're stuck in the previous 10 years winners, you're going to be in big trouble. You can really do some damage here. So, but in the same vein, this is a really good time to outperform. If you know what you're doing, you know what you're looking for, those sectors. I mean, just look at some of these moves. I mean, look at XMET as an example, and this is a perfect example, because this XMET, this is energy transition metals, and we feature this in our model portfolio. It was listed in 2023, did absolutely nothing. So it's doing a Nasdaq now, basically, for 2 years. It did nothing. No one wanted to know about it. Then all of a sudden, it pops its head up, and it's gone from 6. So basically, tripled. It's gone from $6 essentially, or no, it's actually 8. So it's basically doubled. It's up 100%. Gone from 8 to 18, and that's only in a matter of, let's just measure that. It's from the breakout. It's 125% in 223 days. So that's what happens. The longer the base, the higher the space. And that's the thing. That's what's playing out here. So there's a chance, if you're going to stay in the Nasdaq, this is the best case scenario. It's going to be flat and you're going to be stuck there. But as an Aussie investor, if the Nasdaq's flat and the Aussie dollar appreciates, you're going to lose some serious money. And if you're not in things that are in uptrends, and that's why we make it massive focus for investors. We don't want to be in things in downtrends. We want to be looking for these bases, and we want to look for things that are breaking out, that are trending, that are moving, that have momentum behind them. And I don't think we've seen an environment as good as this, just in terms of a changing of the guard. And if you know what you're looking for, there's money to be made, and you can see that through the model portfolio. Like, we've really outperformed in only a short space of time, and I think we'll continue to do so. But that's because I'm competing against an index that's living in the past, basically. So you look at your VHY or STW, that's who I'm competing against as a benchmark, and that's how investors work. We use a benchmark to show how much you're outperforming. But there's no way I'm holding any of these banks. And as this index continues to hold these banks just by their sheer size and they start to underperform, then all I need to do is hold BHP and Rio. And that's, to an extent, something we've done. We've got, I think, 60% of the portfolios in resources. And away we go, and the index stays flat or drifts down. And that's where you pick up a huge amount of value in terms of outperformance. And that's exactly what's happening now. So it's never been a better time to be an ETF investor with your satellite portfolio, looking at those sectors and themes, because things are rotating, things are happening. And everyone, has been underweight resources. Everyone's underweight Asia. Everyone's underweight these sectors that all of a sudden just go whoop, because it's a huge change in the guard. It's just the global economy is totally different. There's a multipolar world that's starting to develop. There's so many things underway that you just can't be stuck in the past. So that's point 2. And number 3 that I want to touch on is, again, these resources. So let's just have a look at some of these moves. Obviously, the big winners have been gold and copper. So gold just keeps creeping. And that's the thing. Once again, you look at this chart, no one wanted to know gold. So this, this is 4 years there as an example, and then a lot longer before, no one wanted to know gold. Then all of a sudden, the bigger the base, the higher the space. And that's exactly what's happened. Then all of a sudden, people are scrambling. Momentum, obviously there's, key factors as to why that's moving. But silver's another example. Pretty much no one wanted to know anything about silver until now. It's just ripped away. It's basically gone, let's say, from $20 back in, say, yeah, even a couple of years ago, so late 2023. So it's up 5 times to 100 now. So it just shows you when a trend commences, when there's rotation occurring, when the time's right, these things can run. The bigger the base, the higher its space. So then what's my view on these at the moment? Obviously, they're extended. At some point, you're going to get a pullback. Like, it's not a matter of if, it's a matter of when you get a pullback, then you'll get another buying opportunity. I don't think this cycle's only just commencing, and some of these moves are so big that it's just the start of what's going to happen over many, many years. So that's the thing. For gold and silver, hold in there. You're in the trend. At some stage, it's going to do this. We're going to buy it again, and then it'll keep going, I think, go for another trend. But then we're looking at things like copper, which haven't moved as much. But you can see at the moment, I was saying, just in terms of this move, so we're looking at having it come out of this little kind of consolidation here, and then it's kind of had one, two, it's kind of two touches of the moving averages, was third push, and I thought it may do this, but that action there on Friday looks like perhaps this is the only consolidation it needs, and it can start moving higher from here. And why I have that view? Because I'm also looking at things like aluminium. That's another example that looks exactly the same as copper. So it just sat there, consolidated a little bit, and maybe that's all it needs. It's come into that 10-day moving average, popped up here, and just feels like, obviously it's had a strong move out of here, and it can pull back. It could pull back all the way back to the top of this space, but it's only pulled back to here. It's already finding buying. Feels like that's going to go already. Then you've had something like zinc, which hasn't moved yet, but that looks like it's starting to go now, and that's only just coming out of the base. So that's stage one kind of base, only just popping its head up here. That feels like it's just wanting to go as well. So it's kind of like the precious metals are moved. Now your base metals, obviously you've had copper. So there's things that are really, really in short supply are starting to move. And I think it's only just getting started. And then also we have a look at something like tin, which we can't access in Australia. But this is an example into new all-time highs. No one's talking about it. But on the weekly, there's your really, really nice base. Away it goes, and then look, how far has that got to go? Well, depends on supply and demand, and everyone's scrambling, and how key tin is in terms of the use cases in different economies globally. But at new all-time highs and extremely strong trend even out of here. So it's basically gone from, so say in December, from 90 to, so it's kind of up 30. What's that? So this was kind of the breakout here. So you're already up kind of 50%. Since late last year, and it just feels like it's getting started. Like this, once again, look at this this little consolidation. Let me get that off. Yeah, just this little consolidation. I was thinking, that's what I was drawing on the silver chart. Maybe it comes back. Maybe it comes back all the way here. But as we look now, perhaps that's the only amount of consolidation that it needed, and it's kind of bounced off that 10-day already and just hit into new highs. See huge volume as well. So we're seeing that along a number of commodities, which gives me, obviously a lot of confidence. This is only just beginning. And then we've obviously got uranium, we've got soft commodities, we've got food, we've got so many other things to play within that same theme. So obviously gold and silver, we've got the focus. They move first. But what's next? Energy, all these things are out there to be played. And there's some ETFs we can access as hedged ETFs. I think, that's exactly what we're looking at for subscribers. So it's really exciting times if you know what you're looking for. But if you're on the wrong side of this, just with a currency, with the way the indexes are worked and they're overweight in sectors that are really starting to underperform, you've got that rotational environment, you can really do some serious damage at the moment. So not only is it very exciting if you know what you're doing, it's also can be extremely damaging if you're only maintaining the status quo and thinking what happened in the last 10 years is going to happen in the next 10 years. So I'll pull it up there, but thank you for listening again. And once again, remember, follow the trend.